Every system has an architecture. Most people see the facade. This is what's underneath. $141 billion in US Treasury debt held by a company nobody is allowed to audit, more than Germany, more than Saudi Arabia, more than South Korea. 18 months ago, that company held $80 billion, then Congress signed something, and the dollar's largest private creditor became unauditable by law. The company is called Tether Holdings Limited. It is registered in the British Virgin Islands. It does not file with the SEC, the Securities and Exchange Commission. It has never been audited by a Big Four firm, and as of the fourth quarter of 2025, its treasury holdings rank 18th in the world, directly above Germany, which sits at $111 billion. This is not a long-term position. This is a sprint. In the first quarter of 2024, Tether's treasury holdings stood at roughly $80 billion. By March of 2025, $98 billion. By the first quarter of 2025, $115 billion. The moment Tether crossed Germany for the first time, by the close of 2025, $141 billion, a $61 billion treasury accumulation in 18 months. By a single private issuer, with no public balance sheet audit. The Brookings Institution paper published in October 2025, authored by Davidovich, Ghani, and Majoro, placed stablecoins among the top 6 to 7 net buyers of US Treasuries in 2024. Not crypto firms collectively, stablecoins specifically, a category that did not exist as a meaningful treasury holder before 2023. Citi Research, in an August 2025 note, projected that by 2030, stablecoin issuers will collectively hold more US debt than China and Japan combined. The two largest foreign sovereign creditors of the United States were placed in the math by issuers of digital tokens whose reserve composition is verified by quarterly attestations rather than audits. This is the position. The question is how it became legal. A stablecoin is a token pegged 1-to-1 to the dollar. The promise is simple: deposit $1, receive a token, burn the token, receive the dollar back. The peg holds because the issuer claims to hold $1 of reserve for every token in circulation. For Tether, those reserves are not held in cash. They are held primarily in short-term US Treasury bills. Every USDT token issued is, in effect, a claim on a treasury holding. As demand for USDT grew from roughly $70 billion in early 2023 to over $180 billion by the end of 2025, Tether had to buy treasuries to back the issuance. The growth of the token forced the growth of the treasury position. This is why the relationship is not symmetric. A foreign central bank can choose to hold or sell US debt based on national interest. A stablecoin issuer must hold treasuries proportional to token demand. The buyer is structural, the buyer is mechanical. In May of 2025, Senator Bill Hagerty introduced the GENIUS Act. The acronym stands for Guiding and Establishing National Innovation for U.S. Stablecoins. On July 18, 2025, President Trump signed it into law. The act does 4 things that matter for this record. First, it codifies that payment stablecoins must be backed by U.S. Treasuries, cash or cash equivalents, not gold, not foreign currency, not corporate debt. Treasuries by law. Second, it prohibits foreign-issued stablecoins from circulating in U.S. markets unless they meet equivalent reserve requirements, effectively building a regulatory moat around domestic issuers. Third, it bars yield-bearing stablecoins from being issued by federally insured banks. JP Morgan, Citi, Bank of America, all the institutions with audit infrastructure already in place are blocked from competing in the highest margin segment. Fourth, and this is the section the record returns to, Section 4 of the Act specifies reserve composition and reporting standards. It mandates monthly attestations. It does not mandate annual Big Four audits. The original draft of the bill, circulated in April of 2025, contained language requiring full audit by a registered public accounting firm. That language was removed during committee markup. The amendment removing it was not subjected to floor debate. The bill passed. The audit requirement did not. But here is what the record actually shows. Tether does publish quarterly attestations. Those attestations are performed by BDO, a respected accounting firm, but an attestation is not an audit. An attestation confirms a stated balance at a single point in time. An audit examines the integrity of the underlying reserves, the quality of the assets, the existence of pledges or encumbrances, and the operational controls of the entity. Attestation is a snapshot. Audit is a documentary investigation. In December of 2025, S&P Global downgraded Tether's USDT stablecoin. The published rationale cited concentration risk in reserves and limited transparency on counterparty exposures. HSBC's research desk, in a follow-up note dated the same week, warned of revived depegging risk. Polymarket prediction contracts by the close of the year were pricing the probability of a USDT depeg event in 2026 between 14 and 18%. That is not a forecast, it is a market signal. The price institutional traders were willing to pay to hedge against a Tether failure. Now overlay that on Section 4 of the Genius Act, a company whose ratings agency has flagged opacity, a company whose hedging cost in derivatives markets implies double-digit failure probability, a company registered in a jurisdiction with no requirement to disclose beneficial ownership. That company is, by federal law passed in July, the legally protected backstop for $141 billion of US Treasury demand. And the audit clause that would have permitted independent verification of its reserves was removed from the bill before the floor vote. A reserve you cannot verify is not a reserve, it is a promise. The architecture is not hidden, it is documented in congress.gov. Senate Bill 1582, Section 4. The amendment history is public. The question the record forces is not whether this happened, it is who benefits. 4 actors, 4 incentive structures, each traceable. The first actor is the US Treasury and the Federal Reserve. Foreign sovereign demand for US debt has been declining since 2022. Japan reduced holdings to manage yen weakness. China reduced holdings as part of strategic decoupling. The Treasury has issued record volumes of debt to finance deficits running near 6% of GDP. A new structural buyer, one that scales mechanically with token demand and cannot by design sell tactically, relieves yield pressure on auctions. Stablecoins do not threaten dollar dominance, they subsidize it. The second actor is Tether Holdings Limited. Before Genius, Tether operated under regulatory ambiguity. After Genius, Tether operates under regulatory protection. The Act creates a federally sanctioned category, the payment stablecoin, and Tether's compliance posture matches the new template by construction. Foreign competitors are barred from the US market. Bank-issued competitors are barred from yield-bearing products. Reuters reporting in 2025 placed Tether's potential public valuation north of $500 billion. The path to that valuation runs through a law that codifies its position and exempts it from the audit standard applied to every other entity holding equivalent volumes of public debt. The third actor is the Wall Street banking complex. JP Morgan, Citigroup, Bank of America, Wells Fargo, each blocked from the highest margin stablecoin segment by Section 5 of the Act, each watching a parallel monetary infrastructure consolidate outside their balance sheets. The losers in this architecture are not retail investors. The losers are the institutions with the audit infrastructure and the compliance overhead, the institutions for whom transparency is a fixed cost rather than an avoided one. The fourth actor is Congress itself. The Genius Act passed with bipartisan support. The audit amendment was removed in committee. No senator placed a hold on the bill. No floor speech contested Section 4. The codification proceeded without public debate over whether the largest non-sovereign holder of US Treasuries should be subject to the same disclosure standards as a regional bank. That silence is its own data point. 4 actors, each acting rationally within their own incentive structure. The architecture is not a conspiracy. It is the predictable equilibrium of who benefits from what. The architecture diagrammed. The question the hook posed was who decided that the dollar's largest private creditor would be unauditable, and when the record answers in sequence. The decision was made in committee in the spring of 2025 by an unrecorded amendment that struck the audit requirement from the original draft of Senate Bill 1582. The decision was ratified on July 18th of the same year, when the President signed the Genius Act into law. And the decision will be tested not by regulators, not by Congress, but by the first stablecoin balance sheet stress event large enough to force the question Section 4 was designed to defer. A reserve you cannot verify is not a reserve, it is a promise. A reserve you cannot verify is not a reserve, it is a promise. The dollar's last marginal buyer is now structurally a private company in a jurisdiction without beneficial ownership disclosure holding more debt than 3 of the G20's sovereign creditors combined, protected by federal law from the audit standard that applies to every other entity of equivalent systemic weight. That is the architecture as of the fourth quarter of 2025. It is not contested. It is not theoretical. It is the record. The system keeps moving. So do we. Until next time, question the architecture. Chapter 48 of the Dominion Archive. What happens when the audit you cannot have is finally demanded? And by whom?